Welcome to the Daily Insights That Matter. Have you ever heard of the term the underwear index? Now, the men's underwear index is an economic indicator that can supposedly detect the beginning of a recovery and a phase of an economic slump. Now, in simple terms, it tells us a lot about the current state of the economy. Let's discuss this economic indicator today. Now, the men's underwear index is an important economic indicator as the underwear is the most private and hidden article of clothing. Therefore, when money supply is limited, it is not replaced as frequently. Now, in simple words, it means that a decline in men's underwear sales indicates a potential slowdown, while an upswing in the sales predicts an improvement in demand. Now, this could be a great indicator to signal an upcoming slowdown in the economic activity. Talking about the situation in India, underwear sales of major manufacturers have dropped in the quarter ending December 2022 when compared to a year ago period. Now, as seen in the chart, it is evident that innerwear companies have had severe decline in volumes, thereby affecting their stock price drastically. The underwear index is not an absolute measure of the economic activity, but these give an early indication of a trend starting. There are multiple such indices such as the lipstick index, the haircut index, the Big Mac index, etc., which are indicative of the trends in an economy. But the bigger question here is, would you base your investing decisions on the number of underwears or lipsticks or McDonald's burgers sold only? Well, we hope not, because there are multiple other factors which are otherwise indicating towards a sustained growth in the economy in the long term. Now, we had discussed a lot of these factors which indicate the inherent strength of the Indian economy in our Third Empire episode, which was released last weekend, and we strongly urge you to watch it. Additionally, we would like to draw your attention towards another such indicator, that is the Consumer Confidence Index. Now, the Consumer Confidence Index is a survey that indicates how optimistic or pessimistic consumers are regarding their expected financial situation. Now, the chart clearly shows how the consumers are regaining confidence since the downturn seen during the pandemic. Now, according to data from the Reserve Bank of India, banks' credit growth eased marginally to 16.8% year-on-year in the December quarter from 17.2% seen in the September quarter, despite the continued rise in the interest rates. Now, the bank credit had grown at 8.4% in the year-ago period. Now, the credit growth has been strong in FY 2023, driven by retail credit demand, strong growth seen in NBFCs, and the inflation-induced working capital requirements from industries such as petroleum, chemicals, glass, and plastic. Now, deposits, on the other hand, rose by 10.3% year-on-year in the December quarter, led by the growth seen in the term deposits. Now, despite the current high interest rate environment, bank credit growth has been strong for the last couple of quarters. Fortunately, deposit growth has also been slowly catching up, which is important because banks need a stable source of funding to support their lending activities. If one looks at the broader data, deposit rates are now slowly inching back to the 11% mark as the banks have started to offer higher interest rates to mobilize deposits. Now, this is indicative from the fact that the gap between deposits and credit growth is slowly narrowing to 6% as seen in February from 8% as seen in December. So what does all of this news mean for you? While the underwear index is not an absolute measure of the economy, it does imply that there is a potential slowdown in economic activity. In the near term, due to global headwinds, there could be some obstacles, but the long-term story for India continues to remain intact. This will therefore have an indirect neutral impact on you. So far, the Indian banking system has demonstrated resilience as the December quarter performance reflects healthy position of the banking sector. However, going forward, while credit growth is expected to moderate, deposit growth will inch up on the back of higher interest rates. This will therefore have an indirect positive impact on you. While I say this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.